How do ETFs work? Exchange-traded funds, or ETFs, are versatile instrument vehicles that pool capital from numerous investors to purchase a diversified basket of securities, such as stocks, bonds, or commodities. They are structured to track the performance of a specific underlying index, sector, or asset class, providing broad market exposure within a single fund. Unlike traditional mutual funds, which only price and settle at the end of the trading day, ETFs are listed on public stock exchanges and trade continuously throughout market hours. This structural design allows individual investors to buy and sell shares of the fund effortlessly through standard brokerage accounts, just like ordinary corporate stock. Consequently, they offer an efficient mechanism for building a diversified portfolio without the necessity of purchasing each underlying asset individually. The intraday trading capability of ETFs is primarily driven by their market price mechanics, which fluctuate based on continuous supply and demand. Investors can execute a variety of sophisticated order types, including market orders, limit orders, and stop-loss orders, to precisely manage their entry and exit points. Because they trade on an open exchange, the transaction prices of ETF shares are transparent and updated in real time, reflecting immediate market sentiment and economic developments. This liquidity makes them highly attractive to both long-term buy and hold investors and short-term traders looking to capitalize on minor market movements. Furthermore, the ability to short ETF shares or purchase them on margin adds a layer of tactical flexibility that standard mutual funds simply cannot replicate. Behind the scenes, a unique creation and redemption mechanism ensures that the market price of an ETF remains closely aligned with its net asset value. This sophisticated process is managed exclusively by specialized institutional financial institutions known as Authorized Participants. When consumer demand for an ETF spikes and its market price rises above the net asset value, authorized participants purchase the underlying assets, deliver them to the ETF sponsor, and receive newly created ETF shares to sell on the open market. Conversely, if the ETF trades at a discount, authorized participants buy the undervalued ETF shares, exchange them with the sponsor for the underlying securities, and sell those securities for a profit. This continuous arbitrage process effectively regulates the supply of shares, preventing prolonged premiums or discounts and protecting everyday investors from artificial pricing distortions. From a structural standpoint, ETFs are highly regarded for their superior tax efficiency and low expense ratios when compared to traditional actively managed funds. The creation and redemption process is executed entirely through an in-kind transfers of securities, meaning the fund sponsor rarely needs to sell internal assets for cash to meet investor redemptions. Because these in-kind exchanges do not trigger immediate capital gains taxes, the fund avoids paying significant tax liabilities down to individual shareholders. Additionally, most ETFs are passively managed to track established benchmarks, which drastically reduces management fees, administrative overhead, and internal transaction costs. These combined attributes make ETFs an incredibly cost-effective, transparent, and tax-advantaged tool for modern portfolio construction. To learn more about our own legal practice in the area of financing and investments, we welcome you to visit our website and contact our law firm to schedule a consultation. Thank you.